So today we're going to talk about general equilibrium incidence, but I want to start by just clarifying something from the last lecture on IV estimation of price elasticities, which somebody asked a question about. How do we know it's a demand or a supply elasticity? And so what I had said is if you're instrumenting for the post-tax price, you end up estimating the demand elasticity. And if you're instrumenting for the pre-tax price, you end up estimating the supply elasticity. So I just want to clarify why that is. Okay, so suppose your goal is to estimate the elasticity of demand, and you are in a situation like in this diagram here where you don't have perfectly elastic supply. So a $1 change in the tax does not lead to a $1 change in the price. Then how do you estimate the demand elasticity? You instrument for P plus T, the post-tax price, with the tax change. So you're generating variation in the price that consumers face with the tax. And then you end up estimating the demand elasticity. Analogously, if you just change the endogenous variable to the pre-tax price, P here, you end up estimating the supply curve. So let's talk through why that is. So think about the demand and supply curve. And the instrument in both cases, there's a single instrument. It's the tax, right? T. So the first stage for the demand curve is the impact of the tax on the tax-inclusive price. The first stage for the supply curve is the impact of the tax on the pre-tax price. So this is going to be a positive number, and this is going to be a negative number, right? Because higher taxes are going to drive down the equilibrium price that suppliers get paid. Okay, now the reduced form for both the supply and demand curve is just dq dt. What is the impact of the tax on the quantity sold? And so the reduced form is in fact identical in the two cases, right? Because there's just, when you impose this tax, there's a single quantity shift. And the point of market clearing is that quantity change has to be the same, obviously, for the suppliers and the demanders. So what you then get is what's the IV estimate? The IV estimate is just the ratio of the reduced form to the first stage, as we talked about in the last lecture. So for the case of the demand curve, it's this ratio, and for the case of the supply curve, it's this ratio, right? So what may be somewhat confusing or surprising about this is that for both the supply and demand curve, we're just taking the same reduced form estimate, but we're scaling it by different quantities, right? And so one way to understand why that works is that is to go back to the basic incidence formula. So you'll remember that dP dt is just the ratio of the demand elasticity to the sum of the supply and demand elasticities, which we established early on. And so then if you take, and so then analogously, dP plus T dt, so the impact on the post-tax price, is the ratio of the supply elasticity to the sum of the elasticities, okay? So now suppose I divide the two. So look at the ratio of the impact on the pre-tax price to the impact of the tax on the post-tax price. So basically take the ratio of these two first-stage coefficients. What I end up getting is the ratio of the supply elasticity to the demand elasticity. So the reason this makes sense is because, remember, we're saying this is an estimate of the demand elasticity, this is an estimate of the supply elasticity. And the only difference between the two comes from the fact that we're dividing by different things in the denominator, all right? And what this shows you is that scaling factor, the different things that you're dividing by, are exactly related to the ratio of the demand elasticity to the supply elasticity. So this is precisely why you end up identifying the slope of the curve you want to identify if you just instrument for the right price. Okay, so that's one way to do it. Effectively, what you're doing, a way to think about it more abstractly, is that the equilibrium is determined by the slopes of these two curves, right? So there are two parameters you want to identify. And there are two empirically estimated moments. One is the quantity change, and one is the change in prices. And so from those two moments, you can back out the two slopes. And it turns out analytically that a way you can do it without really thinking about it is to instrument for either the pre-tax or the post-tax price. And so if you just work through this math, you'll see why this actually makes sense. Okay, so is that clear? This is why you end up actually estimating the demand elasticity when you instrument for the post-tax price, which is the standard practice in public finance. All right? Okay, so let's turn now to incidence in general equilibrium models. So we've been talking about a two-good partial equilibrium model until now in this class. Now, what's the typical goal of general equilibrium analysis? It's to extend that to usually to trace out the full incidence of taxes back to the original owners of the factors. So in partial equilibrium analysis, like in this diagram here, we often talk about incidence on the consumer versus incidence on the producer. But the producer is not a final entity. It doesn't really make sense to just talk about a producer. Producers can be traced back to capital owners, labor suppliers, landlords, et cetera. There are a bunch of factors that are contributing to production, right? And so when you say the incidence is on the firm, that's not really a meaningful concept. And you really want to trace it back to the owners or the sort of the elements of the firm, right? And so that's one of the main goals of GE analysis. So there are two types of GE models at a high level, static and dynamic. Static models typically have many sectors or many factors of production. And the workhorse analytical static model is due to Harberger in 1962, where he analyzed a model with two sectors and two factors of production. Okay, so that's a limited model. It's less limited than the partial equilibrium model, but it's still making a significant simplification. So the next generation of models are what are called computational general equilibrium models, CGE models, which have many sectors and many factors of the production model. But what you end up seeing very quickly is as soon as you go beyond two sectors and two factors, you can't get analytical representations for the impacts of policies on the equilibria. And so then the thing is extremely messy, and you end up using computational methods. So we'll talk a little bit about that. And then the other class of models are dynamic models, where you characterize the impacts over time or across generations. So rather than just analyzing steady states, you think about the transition path. If we levy increased capital taxes, how is Apple going to adjust their production process, and what are the impacts going to be over time? And that leads to this approach that we'll talk about called capitalization, where there's quite a bit of empirical work recently.
Just a question on the previous slide.
Yeah, sure.
You were saying that what matters is to show the precision of the goods.
Well, we do care, I think. So we do care about distributional incidence across consumers with different types of preferences. So the point I'm making is not that you can't split up the consumer side and we want to split up the producer side. I was just giving you an example of how you want to split up the producer side. You may also want to split up the consumer side by income levels, by numerous other things. So that was not my intention that there's no heterogeneity across consumers, right? So you're right to clarify that. So think of this as one example. Typically, the research has focused on the production side rather than the consumer side, as you'll see. But there's no deep abstract reason for that. So it's a good point. OK, so let's start with the Harberger two-sector model, okay, the simplest GE model. Here are the key assumptions of the model. First, we have a fixed total supply of labor L and capital K. Okay? So there are 100 people who can work, and there are $100 that we can invest in buying machines, let's say. So think of that as a short-run, closed economy. We're going to assume that there are constant returns to scale in both production sectors, which is going to be important because there are essentially no profits earned by these firms. We have full employment of labor and capital, so we're not going to allow for unemployment. There's going to be no sort of frictions or nothing that's going to generate some of these factors not to be used. And finally, we're going to assume perfect competition. An implicit adjustment, which is essentially what the dynamic models are about, is that there are no adjustment costs for capital and labor. So if the price of labor seems higher in sector A than sector B, labor is just going to flow there freely and immediately re-equilibrate. All right? OK, so let's think about now a two-sector version of this model, where, to be concrete, let's say sector 1 produces bikes and sector 2 produces cars. So these two things might be substitutes for each other, and it's intuitive to think that bikes use less capital for production, say, than cars, which require heavy machinery for production. Okay? So we're going to have two, let's let x1 denote the amount produced in sector 1, x2 denote the amount produced in sector 2. And there are two production functions. which map the amount of capital K1 and labor L1 that you use in these sectors to the level of the number of bikes you produce, and similarly the number of cars you produce, X2. And because we've assumed constant returns to scale, we know that F1 of K1 L1 is the same thing as L1 times F1 of K1 over L1, comma 1, right? We can just factor out that L1, and so we're going to let little f of K1 denote the intensive form of the production function. And so we can rewrite this in this way. And then totally analogous structure for sector 2. Now we have these two full employment conditions. All the capital has to be used and all the labor has to be used. Okay? And then we're assuming full mobility, right? So in equilibrium, the returns have to be equated across these sectors. So we're going to let the wage rate be denoted by W. And so that's going to have to equal the marginal product of labor in sector 1 as well as the marginal product of labor in sector 2, right? If that condition is violated, people are either not going to want to work or firms are not going to want to hire the marginal worker if the wage is too high. And then that's going to end up driving down the wage and so forth. And so you're going to end up in this, with both workers and firms optimizing, you're going to end up with this equilibrium condition. Similarly for capital, right? Capital is going to be supplied to the point where the rates of return are equal across the two sectors. Otherwise, you would supply capital to the other sector, whichever had a higher rate of return. Finally, on the consumer side, we have demand functions that are going to come out of utility maximization for the consumers, but we're just going to go straight to what the demand functions look like. And so that's going to be a function of the relative prices of the two goods. So the number of bikes I want to buy is a function of the price of bikes relative to cars, and analogously for the number of cars I want to buy. Okay, so this you can already see is a much more complicated model than the basic partial equilibrium model, right? And so in fact, if you just count the number of equal signs on this slide, you see that there are 10 equations, and there are analogously 10 unknowns. Okay, the levels, the quantities, and the various prices, the output prices, and the prices of the factors, W and R. And so abstractly, what are we trying to do? We're going to introduce a tax in one of these sectors, and then we're going to ask how do all 10 of these variables change, which, as you can imagine, is much, much messier than just thinking about one price and one quantity. So that's exactly what Harberger does. He thinks about what the impact of introducing a small tax d tau on the rental of capital in sector 2 is. Okay, so what is this tax? It's on the use of capital in one sector. Okay, you can think about various other taxes. You can think about taxes on capital in both sectors. You can think about taxes on wages. You can use the same basic structure for all of that. This happens to be the tax he analyzed, and I'll talk about his application later on. So once you introduce this tax of d tau, all the equations are going to be exactly the same as on the last slide, except that in sector 2, the rate of return to capital is going to be 1 minus d tau, because you've got to pay the government fraction d tau of what you earn, times the marginal product of capital. Okay? But remember, it's still going to be the case that the post-tax return on capital in sector 2 has to equal the untaxed return on capital in sector 1. That equilibrium condition is still going to have to hold, which is important. So the technique that Harberger uses to solve this model is a linearization. Just think of that as like implicitly differentiating all the equations on this slide with respect to d tau. And that's going to give you first order expressions for how all of these quantities change as a function of d tau, but it's going to be a simultaneous equations problem, right, where you have 10 equations, 10 unknowns, because each of these things is interdependent on other endogenous variables. All right, so you can see how once you introduce that d tau, you can calculate dw, dr, dl1, dl2, et cetera, et cetera. Now, to think about incidence, it's useful to remember that because we're assuming that the total amount of labor is fixed and the total amount of capital is fixed, the only thing that matters for total labor income and total capital income are changes in prices, right? So how do I think about the total impact on workers? Because the number of workers is not changing, or the amount they're working is not changing by assumption. All that matters is how the wage rate changes, right? So what we really care about is dw d tau and dr d tau if we want to trace the impacts back to the factors, which is one of the goals of this analysis. Similarly, we care about these prices, dp1 d tau and dp2 d tau, if we want to understand how the tax is shifted from sector 1 to sector 2. Now, per se, this is not that interesting because there's no heterogeneity in the basic version of this model, right? There are these demand curves. We're not thinking about some consumers really liking bikes and other consumers really liking cars, maybe low income versus high income, and then you'd have these distributional incidence effects and so forth. All that stuff is basically eliminated by assumption, but could potentially be interesting. So I'm not going to go through this here, but Kotlikoff and Summers write down the 10 linearized equations as a function of various substitutional elasticities, which that's what ends up mattering. That, in my view, is not particularly informative in and of itself, just staring at those 10 equations. So I'm going to talk about what the key forces are embodied in those equations. OK, so the first force that's captured in the Harberger model is the most obvious intuitive one, which is a substitution effect. And that goes towards saying that capital is going to bear the incidence of this capital tax. So what's the logic of that? It's the first thing you think of. If I put a tax on the use of capital in the car industry, automakers like GM are going to shift to more labor-intensive technologies instead of capital-intensive technologies. And so the aggregate demand for capital is going to go down. Because the total amount of capital is fixed, the equilibrium interest rate is going to fall, right? The amount we're willing to pay capital owners. And so as a result of this straight substitution effect, capital is going to bear some of the burden. Okay? Now, the second effect is output effects. So this is a force that's going to lead the other way, that could potentially lead the other way, which might lead capital not to bear some of the incidence. And so this is where you see now the complexity of the general equilibrium analysis, where all the prices are changing. So to think through this, note that a tax on K2 implies that the output of sector 2 is becoming more expensive relative to sector 1. So if we tax capital, it's going to be more expensive to produce cars, so people are going to want to buy more bikes instead of cars, for instance. So demand is going to shift towards sector 1. So let's compare two different cases, okay? The first case is the one that I just mentioned, where sector 1 is bikes and sector 2 is cars, and sector 1 is less capital intensive than sector 2, all right? And remember that we are taxing capital in sector 2 throughout all of these, our entire discussion here. Okay, so because sector 1 is less capital intensive, the aggregate demand for capital is further going to go down through a second effect, right? So not only does GM use less capital relative to labor to produce cars, but consumers, because cars are now more expensive, want to buy more bikes instead of cars, and bikes use less capital than cars, so the demand for capital has further been reduced in general equilibrium, right? And so the output effect in that case is going to reinforce the substitution effect, and capital is going to bear even more of the burden of the tax. Yes?
Here depend on the elasticity of factors?
It depends upon the relative capital intensity.
But not elasticity?
Not the elasticity. Because the elasticity, this effect, the elasticities do matter, like they are controlling things. But the effect that I'm describing here is basically if one of the sectors uses less capital than the other and demand is shifting to that sector, that's the force that's affecting the demand for capital. Are you talking about across the sectors or the factors?
The factors, yeah.
No, it doesn't matter because you're just talking about shifts in demand across the two sectors here. Yeah. Okay, so in this case, the output effect is going to reinforce the substitution effect, all right? Now let's consider the opposite case, okay? So you can see why it's really the relative use of capital and labor that matters from the second example. So suppose sector 1 is cars and sector 2 is bikes, all right? We're still levying the tax on sector 2, just to be clear. Okay, now sector 1 is more capital intensive, so I'm taxing capital in the production of bikes, but people want to buy more cars as a result. Cars use more capital, so this is going to go the other way, where the substitution and output effects have opposite signs, and this is going to lead labor to bear some of the incidence and possibly benefit capital or reduce the incidence on capital. Okay, so these are the two major forces, all right, that are embodied if you look at these 10 equations in the Kodlikov-Chow. Okay, so those are the two basic effects. So now we're going to add the two up and talk about what might or might not happen. And you can see you get an array of different responses. So substitution plus output effects can lead to what people call overshifting effects. An overshifting effect is when if I put a tax of $10, the incidence you pay is actually $15. And that can happen in general equilibrium. That did not happen in the basic partial equilibrium analysis we talked about. All right, so let's think about how that works. Take first the case where bikes, where sector 1 is bikes, sector 2 is cars. So cars are more capital intensive, and that's the sector we're taxing. Okay, so in this case, we can get an overshifting of the tax where the impact on capital owners, dr, is less than minus dt. So this is just what I was saying. I put a 10% tax on capital, but the return to capital actually falls by 15%. And when that happens, everything has to add up, right? So somebody has to benefit, and in particular, the laborers can potentially benefit, strictly benefit from a capital tax. So how does that happen? If we tax capital in sector 2, we raise the price of cars. That leads to more demand for the bikes, the less capital intensive good, less demand for cars. Now this is where you get the substitution elasticities mattering, but on the demand side, if you have very elastic demand, okay, so I'm like basically totally indifferent between having a bike and having a car. Then if the price of producing cars goes up a little bit, everybody says, forget about cars, I'm going to buy bikes. Let's say bikes, to take an extreme example, are completely handmade. They hardly use any machinery. Then what you're going to get is the demand for labor rises sharply, the demand for capital falls sharply, and capital ends up getting hammered because of the sector-specific capital tax, more than just the direct effect of the tax itself. And labor benefits because everybody wants to employ these bike makers, right? Now, you can also get the opposite, where capital is made better off by the capital tax. So let's talk through how that works. Suppose now you have the opposite case where sector 1 is the cars and sector 2 is the bikes. So you're taxing the less capital-intensive sector. Okay, so here what you can end up having is labor being forced to bear more than 100% of the incidence of the capital tax in sector 2. And what's the logic here? If I have a tax on capital in the bike sector, the demand for bikes falls, the demand for cars rises. Capital is in greater demand than it was before. Again, if people are substituting a lot, the price of labor falls substantially because nobody wants to buy bikes and employ these bike makers anymore. Capital owners end up actually gaining, and laborers are unhappy because you've taxed capital, okay? So what I'm trying to illustrate here is, first of all, there's some basic intuitions that this model brings out, which I think is an important contribution of Harberger. But the bottom line here is that the taxed factor, it's not just that theory says the impacts are between a 0 and 100%. Here you can't even say that. It could be negative, it could be over 100%. You really have no idea. It depends upon a combination really of all these substitution elasticities and the relative capital intensity of the two sectors, all right? So that is one example of, I think, a bit of a disillusionment with pure public finance theory in the 60s and 70s, where in many cases you found things like this, where theory is not very informative, sort of anything goes is the result. So there's more interest, I think, from a practical point of view in identifying what actually happens, and we'll talk about that next. Let me just mention what Harberger tried to apply this to talk about a practical problem. In his application, the two sectors were housing and corporations. So the idea is that these are both, sectors that are combining capital and labor to produce things that people want. But capital is taxed very differently in those two sectors because the corporate income tax affects corporations. But when you produce a house, you actually have a lot of tax subsidies, right? Like the mortgage interest deduction. And Harberger's point is that this creates potentially a lot of inefficiency and has complex incidence effects. So today deductions for mortgage interest are about $80 billion total. What Harberger did is made assumptions about these various substitution elasticities and what the production functions look like in the housing sector and the corporate sector, and calculated the incidence of the corporate tax given potential substitution into housing. Okay, so that was the idea of the basic application. Now, that relies on lots of assumptions about the production function for housing and the corporate sector as a whole, which obviously is like a very black boxy kind of thing, because you would think the production function varies across companies in complicated ways, and there are all kinds of corporate finance issues about what firms are actually doing and so on, and all that is totally abstracted for. So I think the conclusions you get from a policy point of view from this analysis are less clear. I think it's useful for building intuition. Okay, questions? All right, so if that's not complicated enough, the CGE models kind of go to the next step. So Harberger analyzed 2 sectors. The subsequent literature expanded the analysis to multiple sectors. As I said, analytical methods like the ones we just talked about are infeasible when you have multi-sector models. And so instead what people did is use numerical simulations to investigate tax incidence effects after fully specifying the models. So one of the early papers here is by Chauvin and Wally. And then Kovlikov and Summers reviewed this literature. This is actually like a massive literature that was very active in the 70s and 80s. And the way this literature evolved is like you further, enrich the model to allow for more and more factors and more goods. So I think one point, like the state-of-the-art model had like 27 different sectors and 39 types of factors or something. And so, you can imagine that there was this vision, I think, in economics at one point that we are going to develop a model of how the economy works and then just simulate what's going to happen, even though we can't solve that model as we perturb various policies. But I think people started to realize that you're making such strong assumptions here. You have no idea what the structure actually looks like, and things are very sensitive to those assumptions. So, just to give you an overview, though, it's useful to understand what these things look like. Typically, you have something like some number of intermediate production sectors, some number of final consumption goods. Now, in these CGE models, what people start to do is actually allow for consumer heterogeneity as well. So J groups of consumers. Each industry has different substitution elasticities across capital and labor. Consumers typically have Cobb-Douglas utility functions over these consumption goods with different parameters. You specify all of those parameters and then simulate the effects of tax changes. So I'm going to talk in the next lecture and throughout this class about 2 different paradigms for welfare evaluation. One that we'll call kind of a structural simulation-based approach. This is a classic example of that. And another is a more data-driven, empirically based approach, which we'll call the sufficient statistic approach, which is very widely used now in public economics, very active. This approach has a lot of intellectual value because if you feel that you've actually done the specification correctly, you can do any number of policy experiments in that model very easily, right? You can have all kinds of different complicated tax systems, figure out what's functioning the best, how it's affecting everyone, and so forth. But you're putting a lot of weight on those assumptions. And so, this is just making that point. So let's take some examples. We assume perfect competition. We make a number of functional form assumptions. We're making a lot of assumptions about these substitution elasticities. You might say, like, why can't you directly feed in the types of empirical evidence that we've talked about in the partial equilibrium context in these GE models? So why do I have no empirical evidence, basically, to show you in this context? It's because the econometric methods that we've talked about so far in this class, you've learned in applied econometrics class, are fundamentally ill-suited for the Harberger type analysis, right? The whole point of Harberger's analysis is that there is no control group, that there are all these complicated spillover effects in the economy. And if you think about the paradigm of all the designs we've talked about, difference in difference or synthetic control or whatever it is, the whole point is that you have some group that's not affected and you're going to compare the behavior of group A with group B. And that contamination is not something we know how to deal with. So, my sense is that this is a major intellectual challenge in public economics that we don't really know much about. And if someone has an idea on how to tackle that problem, that would be a major contribution. Okay, so I now want to talk about a different application which relaxes the assumption of perfect mobility. And this, I think, you actually do get some nice, simple policy implications that have had a real both intellectual and applied policy impact. So this is an open economy model where we are relaxing the key assumption of the Harberger model that both labor and capital are perfectly mobile across the sectors. So the way we're going to think about it now is that the two sectors are not cars and bikes, but different countries. And it's very natural to think that capital is more likely to be mobile than labor in the context of an open economy, right? So if I levy a tax in some place, people, it's complicated to immigrate to a different place, but it's very easy for me to invest in Canada instead of the US, for instance. So Koldikoff and Summers section 3.1 has a good exposition of this if you're interested in reading that. Okay, so this is going to be a one good, two factor, two sector model. So all the countries are producing the same thing. They're all using capital and labor, and then there are two sectors, there are two countries. Okay. Think of sector one as being a small open economy where L1 is fixed and K1 is mobile. And sector two, think of that as being the rest of the world where L2 is fixed and K2 is mobile. Sorry, yes, and K2 is mobile. So capital is mobile in both cases, labor is fixed, all right? The total capital stock in the world is fixed, okay? So there's only a finite amount of capital that we're going to allocate across these countries. So the small country, let's say a small European economy, introduces a tax on capital income. Now we know that after-tax returns have to be equal, right? So let's say Switzerland introduces a small tax, and I can invest in Belgium or in Switzerland. I just want to make money. I don't care. So I am going to demand the same rate of return in both, right, even after tax. So capital, once I introduce this tax in Switzerland, capital is going to flow from country one to country two until the returns are equalized, right, until we're only left with slightly more profitable projects in country one. So the marginal return is the same. Now, importantly, if country two or the rest of the world is large relative to country one, that flow of capital is going to have a minuscule effect, or essentially a zero effect, on the world interest rate. So this is the standard assumption you see in macro classes and international classes of a fixed interest rate based on the world market, right? Now, the wage rate is a function of the local amount of capital and the amount of labor that you're using locally. So it's the marginal product of labor in Switzerland given the amount of capital in Switzerland, right? And we know that K1 is moving to first order. This is actually a big impact. From Switzerland's perspective, it's a big flow of capital out of that country because of the tax. And so because L1 is fixed and K1 is falling, usually we tend to assume that capital and labor are complementary in the production function, coming back to your earlier question. And so that is going to make labor less productive, right? So I get to make less stuff if I have fewer machines, right? And so then the ironic and important prediction that you get out of this is that the return of capitalists within the small country, the Swiss capital owners, they are totally unaffected by the capital tax in Switzerland because they can invest elsewhere, right? And so they're going to demand exactly the same rate of return within Switzerland as elsewhere, and it makes no difference to them. But the workers in the home country bear the burden of the tax. So here, I think this is actually probably right. You get the striking prediction that taxing capital in small open economies is bad for workers, not for capital owners. Even though you might, think from a political point of view, like I'm going to run on the platform of taking money away from capital, you might actually end up hurting, say, the lower income laborers, right? Questions? Okay, so the mobility of capital is what drives the previous result, right? So you can see that if capital is freely mobile, you get the strong prediction that the labor suppliers get hurt. But if capital is actually fixed, then you're back in the Harberger type setup where it might or might not happen, and it's much more complex. Essentially, the reason the result gets so simplified in the open economy case is that you're assuming one of the prices is effectively fixed because you have this infinite substitution elasticity, and that greatly simplifies the problem and gives you a precise prediction rather than the Harberger result of anything can happen, all right? Okay, so the empirical question here then is capital actually mobile across countries? Because if capital is mobile, then you think that you don't want to have capital taxes. And if capital is not mobile, then you might actually be able to extract some money from capital, even in a small economy. So there are two strategies that people have used to test this. The first is a price-based test, and the second is a quantity-based test. That's one way to think about it. The quantity-based test looks at mobility of capital directly. The price-based test asks whether prices are equalized across countries, as we'd expect. So let's talk about strategy one, what I'm going to call the macrofinance approach. So what's the idea of free mobility of capital across countries? What should we see in equilibrium? We should see that net returns are equalized across countries, right? And that there's kind of a mixed answer on whether we see that because of measurement issues. So the general finding is what people call covered interest parity. So one way to state that is that bonds that are protected against fluctuations in inflation and exchange rates have the same rates of returns across countries. So suppose I have an asset that's immune to inflation fluctuations. So like there are these assets called TIPS in the US, Treasury Inflation Protected Securities. Doesn't matter what the rate of inflation is, you're going to get the same rate of return. Okay, so we know what that's like a truly risk-free asset because you don't bear inflation risk. Similarly, suppose you have an asset that's also immune to exchange rate fluctuations. Then we tend to find that these things have pretty similar returns across countries. So that looks like a yes from the perspective of free capital mobility. Interest rates after taxes are in fact equated across places. The problem is that's like a trivial fraction of assets. The much more important class of assets are risky assets like equity, where there's lots of things going on. So you have different returns, obviously. You have unexpected inflation. You have exchange rate risk. All of these things are affected in equilibrium prices and rates of return. But you have no way as the econometrician of testing whether the average rate of return in country A versus country B is sort of the same unless you take a stance on people's expectations, their risk aversion, and various other sort of model-dependent things. It's not as clean as this where you just literally look it up and see if the interest rates are the same. And so then it's like a much more messy situation. Is this true or not? Not really clear. Okay? So that kind of motivates the second approach, which is the quantity-based approach, and that's to look at capital mobility directly. So this is a very famous paper by Feldstein and Horioka in 1980, where they used data on OECD countries from 1960 to 1974, and they just make the simple observation that in a closed economy, by definition, savings equals investment. And in an open economy, savings minus investment equals the flow equals exports minus imports, right? So your deficit, your current account deficit has to match the capital flows to the country. So what's the point? There's a tight link between savings and investment in a closed economy. In Switzerland, if people decide to save more, it shouldn't necessarily mean that investment goes up in Switzerland. Investment should just generally go up throughout the world because capital is flowing freely, right? So that motivates this regression of investment, say, as a share of GDP, on savings as a share of GDP. And the closed economy model would predict a coefficient of 1, and the small open economy model would predict a coefficient near 0, right? Because, as I just said, if savings go up in one place, you shouldn't expect investment to necessarily go up in that place. So what do they actually find? They find a coefficient pretty close to 1. In fact, they can't reject 1 at conventional significance levels. So that actually looks more like a closed economy result than an open economy result. But that created a huge literature that ran these types of regressions and reached somewhat different conclusions, although in a similar vein, right? So the first important point is that while we know in a closed economy beta should be 1, in an open economy, it's too extreme to think that beta should actually be 0. You're abstracting from too many factors. So here are some issues. So first of all, many countries actually have a policy objective that revolves around trade deficits. Okay, so based on that identity, which we just put up here, if I'm interested in my trade deficit balance, like if I don't want to have too large of a trade deficit, I'm basically going to enact policies, like if I'm able to influence my exchange rate, I'm going to enact policies that effectively keep S minus I small. And so what I'm going to end up seeing in the data when I regress S on I is that the two are very highly correlated. They move together. But that doesn't mean that capital doesn't flow relatively freely. It means that there's some third force that's acting to push these two together. The second thing is that not all countries are actually small open economies. So if you just pool OECD economies, let's say you did a pure time series regression, okay? And let's say, to make the problem clear, you just add up the total savings and the total investment in all the OECD economies, and suppose those are the only economies that are really playing a key role overall. Then you know that total savings has to equal total investment in the aggregate, and that's going to give you a coefficient of 1 automatically. So another way to look at this is the fact that the US is an observation in their data, you can't really treat the US as a small open economy because it is going to have a global influence, and that's going to push you towards a coefficient of 1. So again, not totally, you can't conclude from the fact that this coefficient is relatively high that capital is not flowing freely. And then the third problem, which is like totally mechanical and seriously problematic, is that if you look at the accounts, savings is actually constructed from investment in some countries. So obviously, if you regress one on the other, you're going to get a coefficient close to 1. So there's a large subsequent literature that runs similar regressions, finds mixed results. Now, a very rough summary of this is that it finds more flow of capital than Feldstein-Horioka. And I think more interestingly, it finds that those coefficients are falling over time, which is very intuitive because you think the economy is becoming more integrated, right? So I think to roughly summarize economists' view on this topic, people think that you can't extract money from capital in very small open economies, right? So in Europe, if you plot capital income tax rates, you see a very steady decline through what people call tax competition. Everybody's trying to attract the capital to their country, and you're basically getting to an equilibrium where capital is in fact not taxed because of precisely this type of logic, right? It could also explain why, if you think about capital income taxes in the US, the only real policy debate is at the federal level. Nobody is talking about taxing capital income at a super high rate in Massachusetts or in California because we think it would actually be devastating from the state's perspective because there's way too much mobility within the country, right? So I like the open economy application because I think it illustrates the actual power of the GE analysis in a concrete way. Any questions on that? Okay, so now let's turn to dynamic models. So the static analysis assumes that all prices and quantities adjust immediately. But as we've talked about, the adjustment of capital stock and reallocation of labor takes time. And dynamic CGE models incorporate those effects. And as you'd imagine, they're even more complicated. Okay, so I think the way I like to think about static versus dynamic is think of static models as being a description of steady states. So the example often given in the context of labor income taxes is what is a European type tax system versus a US tax system doing in steady state? We think that probably does not have very much to do with dynamics. Those tax systems have been relatively stable for like 25 or 30 years. So a static approach makes sense to think about that problem. But if we're thinking about implementing a policy today in the US and we want to know what happens over the next 10 years, you do care about the transition path and you want to think about a dynamic model. So during the transition path, the measured flow prices that you see, like interest rates and wages, are not going to correspond to the steady state in general. And so then you get to the question of how do you measure incidence in dynamic models? So I think the most important idea in this literature is the concept of capitalization and the so-called asset price approach. So Larry Summers had the insight that asset prices can be used to infer incidence in dynamic models in a very convenient way from an empirical point of view, and it relates to the comment that was made earlier about measuring time series impacts. So let's say our goal is to study the effect of tax changes on these dynamics. What Summers proposes to do is study the effect of tax changes on asset prices, okay? On like stock prices, for example. So what's the key idea here? I am not able to trace out the dynamics very easily because I don't have a good research design to do that. But I can, at a high frequency, look at what happens to the Apple stock price if I levy a tax that's going to hit corporations like Apple hard. And I can ask how much money do investors in Apple think they're going to lose because of this tax. So what's the key assumption here? Efficient markets incorporate all effects on factor costs, output prices, et cetera. All the complicated stuff in the GE models get built into that stock price, right? So levy this tax, the price of iPads is going to go up. I'm going to use more capital or less capital. That's going to affect the wage. Going to potentially lead to capital mobility across countries, et cetera, et cetera. One approach is to measure all of those effects. Very hard to do. Another approach is just to look at the stock price if I want to know what the net bottom line impact is on the corporate sector, right? So that's a great idea for distilling this complex problem to a single statistic that we can measure. It also is a predecessor of this sufficient statistic approach that we're going to talk a lot about. One way to think about what Summers is saying is the stock price impact is a sufficient statistic that incorporates all these other complex structural responses. Now, what's the limitation of that approach? It can only be used to characterize the incidence of policies on capital owners. Fortunately, there are no markets for individuals, right? Like if I could own stock in you, then I could see how that stock price changes when we have taxes, but we don't have that. Okay, so let's just, simple notation just to be precise about what we're talking about here. Usually we think about the value of a firm as the present value of the stream of dividends that it's going to pay out. So firm does some investment, generates some profits. We usually think it's going to pay that back in the form of dividends or share repurchases. So let's just assume they pay out the profits as dividends. Why do I want to own stock in this firm? Because I want to have access to that stream of dividends payments. So let's let dt denote the dividend payment in year t. And then that, should be 1 plus r to the power t there in that formula. We're discounting future dividend payments. And then we just add up the present value of dividend payments. That is, let's say, the price that I sell my good at in period t times the amount that I sell minus my input costs, again, discounted 1 plus r to the power t, right? Okay, so I levy this tax. That's going to affect PT, it's going to affect XT, it's going to affect WJT, it's going to affect LJT. The change in firm valuation, dVdt, that's the impact on the stock price, is going to capture all of those effects, right? That's the Summers idea. So in that sense, dVdt is a sufficient statistic that incorporates all the relevant changes in prices and quantities. So let's talk about some empirical applications. This is a case where modern econometric methods have actually been used to analyze incidence effects because it lends itself well to the modern paradigm. So empirical applications here typically use an event study methodology, okay? I'll talk about what that is in more detail, but basically the idea is to examine the pattern of asset prices or returns over time and look for a sharp break at the time of the announcement of the policy change. So one thing that's important to remember is the distinction between implementation and announcement. So the idea of capitalization is as soon as I announce that we're going to have this tax increase, stock prices change immediately, right? Because we're all trading and trying to make profits in efficient markets. It's not when the tax change actually occurs, which is usually a few months later. That turns out to be a complicating factor because announcement is often not a well-defined thing. So it's like we start to get a sense that Obama is going to win the election or Romney is, and we think tax policies are going to move in a certain direction. All of that stuff in principle is getting incorporated into the stock market. And so it's hard to say, this is exactly when this policy was announced. So that's usually like a complication in this approach, but the studies I'm going to talk about, you'll see how they deal with it. So the classic application is actually David Cutler's undergrad thesis at Harvard, which was published in the AER, which was the effect of the Tax Reform Act of '86 on corporations. And so what he does is Tax Reform Act of '86 changed the way that corporations were treated in a number of ways, and he applies the Summers type idea to think about how that important tax reform affected corporations, okay? So you should definitely read the first couple of sections of that paper because he has a very nice explanation of the idea and the concepts underlying this approach. The empirics themselves, we have much better data today, much better methods. So I'm going to focus on two more recent studies that I think are more state-of-the-art in terms of illustrating how you do this type of analysis. One is a paper by John Friedman, who's here at the Harvard Kennedy School, on the effect of Medicare Part D on drug companies. And the second is a paper by Linden and Rokoff in the ER on the effect of a sex offender moving into a neighborhood on home values, just to illustrate the breadth of things one can look at with this approach. So let's talk about the Friedman paper. So Medicare Part D was passed by Congress in 2003, enacted in 2006. What Medicare Part D did, it's one of the most significant health insurance reforms in the US, expanded Medicare coverage to include prescription drugs for the elderly. Okay? Previously, you had to pay out of pocket, essentially, unless you had some other arrangement. But in effect, you expanded coverage for 10 million people in the US. So major shift outward in the demand curve for prescription drugs. What is the incidence of Medicare Part D? So the goal of the program is to help elderly people buy prescription drugs. What's a potential consequence? Drug companies start to make more money and end up capturing some of this expenditure, the billions of dollars that we're spending on Medicare Part D. All right, so we want to know how much is captured by drug companies. So the basic research design that John uses is an event study. And then he's going to couple that with another design, which I will talk about in a second. So to start, the simplest thing to do is to plot the excess returns for drug companies around the FDA approval of drugs. So this is nice because there is a particular date on which the FDA approves your drug. And there's quite a bit of information conveyed in that announcement. It's not like it's leaked out before to a tremendous degree. So a lot of information value in that single day, okay? Now, when I say excess market-adjusted returns, for those of you who are taking finance classes, that's just like you have some factor model of returns, like a beta, let's say, on the market as a whole, and you subtract out how the market was fluctuating in that day, and then think about the abnormal return on this particular stock. So think of that as just kind of like detrending to deal with other broad fluctuations in the stock market, maybe in this sector and so forth. So before I show you John's result, let me talk about what the idea of doing an event study is. All right? So the event studies are a very powerful research design when treatments are staggered in time across individuals or across companies. So in the case of the drug companies, the key feature of that is that it's not that there's just one day when a drug gets approved. Your drug might be approved on January 5th, and mine might be approved on March 30th. So there's a lot of staggering across time in this treatment. So that's incredibly useful as a source of counterfactuals because we can basically use these treated individuals or treated firms as counterfactuals for each other. So that's great because usually we're worried about comparability of control and treatment, right? And so if one guy got the treatment and another guy didn't get the treatment, you worry about, why did you have your drug approved and I didn't? Maybe your company's better than mine. Like, there are all kinds of differences. But if both of us had our drugs approved, and it just so happened that yours came along 3 months after than mine, that's a pretty good counterfactual for what would have happened to me during that period. So that is very good for identifying sharp short-run effects, but not longer-term impacts. And this relates exactly to your question about how do we identify, can we just use a time series? And this is a case where you can actually just use the time series. Okay, so what's the methodology? Just to be super concrete, we are going to define event time as calendar time minus the date of treatment for each treated observation. So suppose we're looking at annual data, and you get the treatment in 1997, All right? So then I'm going to call 1997 year 0 for you, and I'm going to call 1999 year +2, and 1994 year -3, and so forth. And if I get the treatment in 2001, 2001 is going to be year 0 for me, and et cetera, right? Then I'm just going to stack the data by event time and collapse it and compute some statistic. So typically like average stock market returns or average income or whatever I'm interested in. I might also plot other statistics, which is often very important because a lot of these series are unstable. So you might plot like medians by event time or P90 or the fraction who are working or whatever, right? So this is conceptually very easy. It's a bit messy to code in Stata, and I think actually Jessica has written a convenient edu file that does event study designs. So it's very easy to do. And so then here's the kind of graph you get out of that. So here on the x-axis is event time, that is days relative to approval of the drug, all right? And then this is the excess return in the stock market. And you can see that it's bouncing around, but there's a clear spike on the day that you get your drug approved, which makes a lot of sense. Of course, investors are going to bid up your stock price on that day. Okay, so that's just the raw fact that John starts from. When you get drugs approved, you get a big boost to your stock price. Now, what he does next is test whether that excess return at t equals 0 for high Medicare shared drugs is higher after Medicare Part D passed. So what's the logic here? Like if I have a drug that tends to be used by elderly people, for that drug I have a huge demand shift outward after Medicare D was passed and not for other drugs. And so I'm going to use that relative comparison in the second stage to identify the impacts of the Medicare Part D program. So let's let MMS sub I denote Medicare market share for drug class I. So think of that as in the pre-period, we measure the fraction of people using this drug who are going to be Medicare eligible, over 65. And then we're going to do a diff and diff design with a variable intensity of treatment. So usually when we've been talking about diff and diff designs, there's a control group and a treatment group, 0, 1 binary, right? Here's a case where you have an intensity of treatment, so it's like a dosage effect. Some of these groups are treated a lot, some of them are treated less. It's a continuous measure. And so that motivates the same basic logic of DD, but it motivates an estimating equation like this, where I'm putting this estimated excess return from the event study at time 0 on the left-hand side. And I'm thinking about that as a function of Medicare market share. All right, so that's just like the treatment versus control comparison in the pre-period. The post-2003 effect, after Medicare Part D was passed versus before, and then this interaction effect, which is the thing of interest. So this is like treatment interacted with post, except treatment here is a continuous variable rather than a dummy variable, okay? So let's look at the results graphically. So this shows you prior to the reform, the distribution of excess returns around drug approval. So this is for, he splits drugs into two groups. The purple is low Medicare market share drugs, so think of drugs that are not going to be used by elderly people much. And then the blue are the high Medicare market share drugs. And in the pre-period, what he's showing you is that the distribution of those excess returns, the spikes, it's basically the distribution of the size of those spikes, these two things look pretty similar, right? Now, this is what it looks like in the post-reform period. That for the low Medicare share drugs, it's the purple. For the high Medicare share, the blue. Notice that the blue is right-shifted relative to the purple, okay? So it looks like after Medicare Part D was announced, you were much more likely to have these way high upper tail gains, huge stock price increases, once you announced high Medicare share drugs, but not when you announced low Medicare share drugs, okay? So that suggests that these firms were in fact getting a significant boost, significant increase in net earnings expected by the investors as a result of the passage of Medicare Part D. So I think the study is really nice in its empirical technique, especially the first stage is really compelling, the event study. I joke with John often about how these graphs would be much better if we plotted the raw data rather than smoothing those curves, because this is a fitted kernel density. You have no idea what the data actually looks like in bins around those, throughout the distribution. It's much better, it's much more non-parametric if you actually plot the histogram rather than a smooth kernel density, okay? So if you had the data, you would definitely do that. This is a case where stock returns are incredibly noisy. He's smoothing it out in this way. I think there is an effect. It would be great if we could see it, in a more compelling manner, but it looks like there is actually an impact. So what does he conclude? Drug companies' profits would have increased by $250 billion in present value because of Medicare Part D, roughly suggesting that drug companies capture about 1/3 of the total surplus from the program. So a big chunk of this massive, nearly $1 trillion present value program is captured by drug companies through equilibrium changes in prices. Yeah. Yeah, so what Jessica is saying basically is that it looks like you're getting the diff and diff effect because the control group is changing instead of the treatment group changing, right? So you'd have to argue that there was some other trend that was affecting this, and then you get this relative shift. I mean, this is why, it's not rock solid that this is exactly what's going on. You're right. You're right that you'd need a staggering of the events across the seasons in order to take out seasonal effects. So and what's another way to think about the assumption? What we really need is that nothing can be changing at a high frequency right around that event. So in other words, if the drug had not been approved on this day, I would not see sharp fluctuations in stock prices of one stock relative to another. Now, if that would be violated, seasonal things are one example of how that could be violated, because I might tend to see like sharp spikes in the consumption of oil or something in some parts of the year relative to others, and then that would be a violation of that assumption. So that, you're right, that's one example of, I think, a violation of what is more generally the identification assumption that this thing would look smooth, right? Usually, again, then what one can do is a set of placebo tests or permutation tests, like think about fake events, and then reconstruct these event study graphs. Like in the example you were giving, you would artificially find spikes in that series, and then that should make you worried. So I think the general lesson here is it's useful to do permutation tests or do placebos for any of these designs. Usually event study ends up being pretty compelling because there's no obvious reason that stock prices would fluctuate by such a sharp amount on any given day. And you can kind of see that by visually assessing the days before and after that particular announcement, right? We don't see that many spikes. So, but that's good, very good point. Okay, so let's talk about now the second paper. This one I think is actually quite compelling empirically. So it illustrates a very common application of capitalization, which is to housing markets, to assess the willingness to pay for amenities. A lot of the classic applications in economics are like willingness to pay for a cleaner environment, like Michael Greenstone has a lot of work along these lines, or willingness to pay for better schools, et cetera. So Rokoff and Linden, they're focused on crime, estimating the cost of crime using the capitalization approach. So they examine how house prices change when a registered sex offender moves into a neighborhood. Okay, so you have public data by law on offenders' addresses and property values in North Carolina. And here's their research design. Suppose the person moves in here, in this house marked with an X in the middle of the slide. They are going to take a broader radius around that address. They have address level data and look at house prices in that radius, and they're going to define the treated area as a set of houses that are very close to the house where the person moved in. They're going to compare trends in house prices within this inner circle relative to the outer ring, okay? And so this is the key graph. So 0 is the date that the offender moves in, and then these are price trends before and after for parcels within 1/10 of a mile, so really close to that house, Okay, and you can see that immediately afterward, the sale price of houses falls quite sharply, probably on the order of $5,000 to $10,000. If you just look at where the mean of this is relative to the mean of that. One thing that's not ideal here is, again, this is like a smoothed kernel plot you'd just like to see. And so what that does, which is not great, is you end up having a break at this point just because you're using a different smoothing on the right and the left. So you shouldn't have your statistical technique break at exactly the same point where you're looking for the discontinuity, right? What you want to do is just plot means within bins so that there's nothing special about this point, and then see that there's a jump. In any case, I think it's pretty clear that there is something going on there. And then, in contrast, look at parcels within 1/3 of a mile of the offender location. So like in that outer radius, 0.1 to 0.3 miles, that's shown by the dashed line. And that you can see is relatively smooth. So what they're showing is, using this event study design, prices fall sharply when the offender moves in for houses very close, like on the same block, but not nearby. Okay? Yes?
When you're selling a house, you're required to say that there's a sex offender.
Yes, I believe there's some rule. I don't know exactly how it works. There's some rule about how you have to disclose that information. I don't know if the realtor has to tell you when you go to the house. I think they might have to give you some sort of, it's somewhere listed in the materials that you get, and there's a question of whether people are looking at it or not, and so on. Okay, so they find that house prices decline by about 4% when offenders located within 0.1 miles of a house. They then use that to calculate the implied cost of a sexual offense given the probabilities of a crime. So you know from other data what the probabilities of repeat offenses are, okay? And so the implied, you can then calculate what sort of the willingness to pay to avoid this, right? What's the implied willingness to pay? And so they come up with a number of 1.2 million, which they point out is far greater than what's currently used by the Department of Justice in such cases. But there's an important caveat here, which is if you think about the probability of a repeat offense, it does not decay very rapidly within a 0.3 mile radius of the house. So the fact that you find a very sharp impact very close, but not just slightly further away where you still might have a similar risk, suggests that maybe this is not about the true cost of crime. It's some sort of behavioral effect where when you're selling a house, it's very difficult to do that when you have to disclose this information about the person living across the street. But if it's a couple blocks away, it somehow is much less salient or something like that. And so, again, you have to think about what exactly you're estimating here, even though it's very well estimated statistically. Yes?
But isn't it, I think it's
Yes. So really what's the actual thing you can estimate here? What does that gradient look like, right? Rather than picking arbitrary boundaries, you can estimate the gradient of treatment effects by distance to the person's house. That would be the fully non-parametric way to do this. I don't think they actually do that in the paper, but I think that's the right way to think about it. There's nothing special that happens when you cross 0.1 miles, as you say. Yeah. Okay, so the last thing that I want to talk about in the remaining time that we have here is mandated benefits. That's the last topic we're going to cover on incidence. So until now, we've focused on the incidence of price interventions, like taxes and subsidies. But there are totally analogous issues with all various other types of policies, and in particular in policies that make quantity interventions, that is like regulation. Regulations also have similar incidence, and I want to talk about that in the context of mandated benefits, which are requirements that employers do something. So a very common type of mandated benefit is that you have to pay for health care, or you have to pay for workers' compensation benefits. That's an important mandated benefit in the US, where Harvard, if it's employing somebody, has to cover workers' comp. So if somebody gets injured while doing work here, Harvard's going to cover that. Another example might be mandated benefits for childcare in European countries and so forth. So I think one reason mandates are very attractive politically is that they're sort of off budget. So when you think about total government expenditure, a requirement that you have to provide workers' comp doesn't make government look bigger. It doesn't cost you more in terms of tax dollars, even though in effect you are making Harvard bear that additional cost in order to hire a worker, right? And so that could reflect salience issues. So it's tempting to view mandates as additional taxes on firms and just apply the same analysis as above. So suppose providing workers' comp insurance costs 2% of a worker's earnings on average. Think of that as a 2% tax, right, that Harvard has to pay every time it hires somebody, and maybe that's it. But that's not right, and that's another paper by Larry Summers, which has been very influential. He shows that mandated benefits affect equilibrium wages and employment differently than a tax. And the key difference is that mandates, there's a tax benefit linkage. Every additional dollar that I earn as a worker, I'm also getting some benefit. I'm not just paying the firm is not just paying a tax, okay? And so mandates create benefits for the workers, so the effect on market equilibrium ends up depending not only on this tax effect, which we've talked about, but on the benefits workers get from the program, okay? And in the extreme case, unlike a tax, mandates may end up having no distortionary effect on employment and only an incidence effect. That is only an effect on wages. So let's talk about why this is. So Summers' 1989 model, very simple setup. Labor supply and labor demand curves are functions of the wage, W. Initial equilibrium, market clears at wage W1. Government then mandates that employers provide a benefit that costs T, okay? It costs T dollars to provide this benefit. To make it super simple, think of it as like we have to provide free lunches for all of our workers, and that costs $5 per person. Now, workers value that benefit at alpha T dollars. So if you don't like the lunch, alpha might be very small, and if you value the lunch at cost, alpha might be 1, right? So, and it's also possible that you might have alpha greater than 1. Now, in the context of lunches, that would be kind of weird. Why would you value a sandwich at more than what you could have bought it at? But in the case of market failures, that's actually plausible, right? So health insurance markets. We think that employers are able to provide you health insurance at a cheaper cost than you would be able to buy in the private market because they're overcoming adverse selection problems through risk pooling, right? So there are legitimate cases where alpha is probably greater than 1. So what is going on here? The cost of labor is now W plus T, because I've got to provide this lunch for every guy I hire. But the effective wage that the worker is getting is not W, it's W plus alpha T, because he put some value on that benefit. And so in the new equilibrium, which clears at a wage W2, you have D of W2 plus T, that's the labor demand, equals the amount that people are supplying with this additional alpha T term. That's what's different from the tax case, okay? And just to be clear, what's different between the tax and the mandate? With the mandate, you don't get the free sandwich unless you show up to work. So it's directly linked to your work. That's why it's a payment for work. I could tax finance the free lunch program where I tax everybody and then just provide sandwiches to everyone. Then I do not get the alpha T effect because it's not linked to the amount that I work, right? So it's the linkage between the behavior and the benefit that's crucial here. All right, so simple graphical analysis is the last thing we'll do here. Initial equilibrium, W1, L1, right, in the labor market. Implement the mandate. It's $1, let's say, increase in cost for hiring workers, shifts the demand curve inward. If this was a tax, that would be the end of the analysis, and that's what we've been talking about. What happens here is you have this additional effect where the supply curve shifts outward because the worker says, you know, at this firm, I don't have to bring my lunch, but at this other firm, I have to bring my lunch, so I value working here more. I'm willing to work at a lower wage because I get that benefit, because I get the health benefit and so forth. How much does it shift outward by? Shifts outward by an amount alpha, right? If alpha is 0, there's no outward shift. If alpha is 1, it's going to shift by the same amount as the demand curve, and you're going to end up at these two curves intersecting again at L1, just with a lower wage. And what ends up happening in that case is the incidence of the mandate is passed one-to-one through to the worker with no impact on equilibrium employment. So very important insight here because this can be a much more efficient way to finance the types of benefits you want to provide as the policymaker. Rather than taxing and providing this benefit, if you provide it as a mandated benefit, you create no distortion in the amount that people are working, which is the next thing that we're going to talk about on efficiency. So let me quickly run through the slide because it's the last thing on the Summers model. Okay, so the algebra is not important. You can work through it later. But he, again, takes a linear expansion around the initial equilibrium. So just implicitly differentiate the supply and demand equations. And you end up getting an equation for dW dt, the incidence of the tax on the wage, that looks like this. And what you'll notice, and the elasticities here are the supply and demand elasticities for labor. And what you'll notice is that if alpha equals 1, okay, dW dt is going to be -1. That's that one-for-one reduction in the wage that I was talking about graphically. And you have no effect on employment. And if alpha is 0, then if you look at that formula, you're back in the tax case, where it's just a ratio of the elasticities to the sum of the elasticities. And then if alpha is between 0 and 1, the general result is that a mandate is equivalent to a tax of size 1 minus alpha. Okay, so if workers value it at 50%, it's 50% as damaging as a tax in terms of efficiency and has 50% as large incidence effects. So in the next lecture, we'll talk about an empirical application, the Acemoglu and Angrist paper, and then talk about efficiency. So let's get started. So today we're going to wrap up talking about incidence with an empirical application on mandated benefits. And then we'll turn to the next topic of this class, which is efficiency costs of taxation. So there are several applications in the literature of the theory of mandated benefits, thinking about how mandated benefits affect equilibrium prices, as we discussed at the end of the last lecture, the Summers model. And most of these applications use difference in difference methods. So because there isn't a great deal of methodological innovation in these studies, I'm not going to go through in great detail a bunch of these papers. Instead, I'm just going to focus on the last one by Acemoglu and Angrist on the Americans with Disabilities Act, because it has some nice insights on how mandated benefits can work in practice and how they interact with other regulations in the economy. So Acemoglu and Angrist study the effect of Americans with Disabilities Act regulations on wages and employment of the disabled. So this 1993 act requires employers to do two things: make accommodations for disabled employees, so this is like provide wheelchair access ramps and things like that, and importantly, pay the same wages to disabled employees as to non-disabled workers. Okay, so what the government is trying to do from an equity point of view is say you have to make accommodations for disabled workers, but you can't make the disabled workers pay for them, right? You can't reduce their wages, which is what we'd expect to happen following the logic of the Summers model. That is, wages would get bid down for these workers if I can pay different wages to different types of employees. So they estimate that the average cost to accommodate disabled workers is roughly $1,000 per person on average, okay? And the important thing to note is that the theory is now ambiguous on the net employment effect because of the wage discrimination clause, right, which I will show you in a second. So take a look at this diagram here, where employers, it's the usual mandated benefits thing for the employers, right? This is the initial demand curve for labor, and then it shifts inward to D2 when they're forced to pay this essentially $1,000 tax for every additional disabled worker that they hire. Now, we also get this beneficial shift of the supply curve shifting outward because the disabled workers value that benefit, right? It's a little bit easier to work. You're possibly willing to work at a lower wage, so the supply curve shifts outward. However, okay, so if the disabled workers valued the benefit at cost, we know from the Summers model that all that would happen is wages would fall by $1,000 and there would be no effect on the employment of disabled workers. But here there's a complicating factor, which is that the government has essentially imposed a minimum wage. The government has said you cannot cut the wage significantly below what you were paying before to these workers, and especially relative to other workers. So what is that going to do? I can't re-equilibrate the market by bringing the wage down to this level. So I end up going to this point where I have an excess supply, that is, I have unemployed disabled workers who are willing to work at that wage, but firms are not willing to hire them at that wage, and the market doesn't clear, right? And so as a result, what can end up happening is that you actually end up reducing the employment of disabled workers because you're taxing firms and not allowing them to reduce wages. Okay, so this is the hypothesis that they want to study. How much you actually affect the employment rates of disabled workers because you have these regulations. So they estimate the impact of that reform using data from the current population survey. And it's a standard diff and diff design. They examine employment and wages of disabled workers relative to non-disabled before and after 1993. Okay? And here's the key graph. Okay? So it shows you the time series around 1993 of employment rates, or the number of weeks worked in the year, the average number of weeks worked, for 4 groups: men and women, and disabled and non-disabled. So as you'd expect, for non-disabled workers, employment rates are higher. They're working more weeks on average per year. So those are the top 2 curves here. And then for disabled workers, the employment rates are lower. Now, if you look before versus after, these series are fluctuating a little bit. So this is not the most convincing graph you've ever seen. But it looks like the employment rates on the right side for, say, the disabled men or especially the disabled women are lower than prior to the reform. In contrast, for the non-disabled men and women, employment rates are almost perfectly flat over this period. And so that's how you get the diff and diff impact, that it looks like employment rates fall for these disabled workers relative to non-disabled workers, even though the idea of the act was to help these workers, right, to help them work more, help them earn more. Okay, so they estimate a standard diff and diff specification. Focus on the red box first. Okay, so what this is showing you is the set. This is like a fully non-parametric version of a diff and diff. So what you do is you interact an indicator for being disabled with all the year dummies, and then you also include, not shown in this table, the year dummies themselves and the disability indicator, right? So then what these coefficients represent are the differences between the employment rates of the disabled and non-disabled workers, the relative differences over time, right? And the key thing that you want to look at is how those coefficients change in 1993. And you can see that before, the coefficients are all statistically insignificant and relatively close to 0. And then right in 1993, the number of weeks employed falls by 1.44, 1.63, and so forth. So you can see this divergence starting exactly in 1993. What's the advantage? So you could just plot these coefficients, right? That would be analogous to like doing a diff and diff graph. What's the advantage of running this regression specification instead of just plotting the raw time series? It's that you can control for various other factors. So this is the way in which you do a non-parametric diff and diff with controls in the background. So you can add a bunch of regressors, like they include a linear trend, for instance, take out a linear time series effect, and you can do various other robustness checks along those lines. Okay, so that just confirms what we saw in the basic graph. And then this here is earnings, so total earnings. And we can see, again, because these workers are working fewer weeks, they're earning less once the regulations are put in place. So Asimoglu and Angrist estimate that there's about a 1.5 to 2 week drop in employment for males, roughly a 5 to 10% decline, which is roughly a 5 to 10% decline, right? Wages did not change. That is, employers appear to have adhered to the law. And so as a result, earnings fell significantly, right? And one of the things that the study implies is that the labor demand elasticity is about -1, given the cost of accommodating disabled workers. You can see how you calculate that, right? If I know that the costs have gone up by $1,000 and I know how many fewer guys I'm employing, I can calculate what the labor demand elasticity is. So what I find really interesting about this study is that it illustrates why thinking carefully about incidence is really important from a policy perspective. This ADA Act was intended, obviously, to help people with disabilities. But their point is that it actually appears to have hurt many of them because of the wage discrimination clause. So even though you have good intentions in saying you should pay these people and you should provide these benefits, it's clear that the intentions were positive. You actually end up possibly hurting some of these individuals. Yeah.
What was that clear to me is that are these costs of making adaptations for the disabled, they seem like fixed costs to me.
Yeah. Well, I don't know if you should. You're right, and that would change the analysis. But I think the way you should think about this is the more disabled workers you have, right, maybe the more accommodations you have to make. So if you have a bigger company with, let's say, one disabled worker, you might have to have a certain number of special facilities, but if you have 10, you might have to have more. Or especially in small companies, if let's say you're just hiring your first, you get 2 applications. One guy has a disability, one guy doesn't. You don't have to do anything if you hire the guy who doesn't have the disability. But if you hire the guy with the disability, you have to put in the ramp and whatever other stuff you need. And then it's going to affect your hiring decisions. Yeah, other questions? Okay, so that's it for the section of the class on incidence.